Cisco Systems Inc., trading under the ticker CSCO on NASDAQ, is currently sitting at $77.16 USD, which marks an impressive 4.32% jump so far in today's intraday trading session. The initial expectation for a company like Cisco, the networking equipment behemoth that many investors, especially those who prefer a more hands-off approach with intelligent portfolio options from providers like Schwab Intelligent Portfolios or the streamlined experience of online investing through platforms like Fidelity or Robinhood, often view as a stable, mature technology staple, was one of moderate, steady post-earnings upside. It's the kind of stock people put their investment capital into for relative safety, not for a sudden surge. But the immediate, more compelling reality is that this move is not just about a typical beat and raise quarter. It's being fueled by a surprisingly aggressive and highly specified commitment to the AI networking space, specifically from hyperscale cloud customers. Cisco is not just participating in the AI boom, they are converting massive previously anticipated demand into concrete, multi-billion-dollar orders right now. That is the kind of insight that shifts the narrative instantly and makes this stock movement much more than a blip. The common ground narrative is straightforward. Cisco is the plumbing of the internet and enterprise infrastructure. They make the routers, the switches, the collaboration tools like WebEx, and a growing suite of security software, the foundational, unglamorous technology that keeps businesses running. This general belief holds that Cisco's growth is tied directly to the steady, cyclical upgrade path of corporate IT spending. And for many investors engaging in self-investing on sites like Interactive Brokers or SoFi Invest, the appeal is the solid dividend and the perception of a low-beta technology play. However, that perception is now being seriously challenged by the reality of the fiscal first quarter earnings report. The deeper take here is that the earnings surprise, which saw adjusted earnings per share hit $1, beating the consensus estimate of 98 cents, wasn't just a slight overperformance. It was entirely driven by the high-growth segments. The networking segment, the heart of the hardware business, saw a substantial year-over-year increase, and crucially, they reported $1.3 billion in artificial intelligence infrastructure orders from hyperscale customers for the quarter alone. Furthermore, Cisco is projecting at least $4 billion in hyperscale AI orders for the full fiscal year 2026, which is more than double their prior year's figure. This signals a tectonic shift in the company's growth profile, moving from steady infrastructure replacement cycles to high-velocity, high-demand AI build-outs, putting them squarely in the same high-momentum narrative as NVIDIA stock, though with a much more mature and financially stable base. This kind of sudden, outsized demand is what drives a 4.32% intraday swing to a fresh 52-week high, a movement that immediately attracts massive institutional attention. Looking at the recent stock movement, the dramatic volume confirms this shift in sentiment. Trading volume today is already significantly higher than the average, indicating a scramble for shares as the market digests the implications of the AI order book. The stock has been trending upward for the better part of the last month, having rallied over 25% year-to-date even before this latest jump, suggesting a pre-earnings anticipation of good news, but the magnitude of the AI guidance was clearly beyond what was priced in. This kind of institutional activity is telling. When we examine institutional holdings, while the long-term trend shows thousands of institutional owners holding billions of shares, the recent filings will be key to understanding who is actively increasing their position right now to capitalize on this AI exposure. The stock's price surge, which now has it trading above many recent analyst target prices, including Goldman Sachs' $75, demonstrates the market's propensity to move ahead of the slow adjustment of target prices. For individual investors using an individual brokerage account or the Fidelity mobile app, this is a moment to recognize that the boring network equipment stock is now performing like a growth tech stock. The macroeconomic pressures of late have been generally favorable for tech spending, with enterprise digital transformation continuing. But the real tailwind for Cisco is specific: the capital expenditure budgets of the largest cloud providers and the proliferation of large language models requiring exponential increases in high-speed, low-latency networking. Cisco's Silicon One chips and its advanced routers and switches are the literal connective tissue for these vast AI data centers. Furthermore, there's a significant secondary catalyst: a major multi-year, multi-billion-dollar campus networking refresh is now underway, as management noted. This means the legacy business isn't fading, it's getting a large-scale delayed upgrade, providing a solid floor of revenue while the AI orders provide the growth ceiling. This 1-2 punch is the real story behind the CSCO ticker's current momentum. Now, to briefly establish the core business, Cisco Systems Inc. is fundamentally the largest provider of networking equipment globally. Their business model has been steadily migrating from one-time hardware sales to a more predictable subscription-based model for software and services, especially in areas like cybersecurity, through products like their next-generation firewalls, and collaboration with the WebEx suite. Their competitive landscape includes companies like Arista Networks and Hewlett-Packard Enterprise, but Cisco's sheer scale and entrenched presence in nearly every major enterprise and public sector institution gives them a deep competitive moat. While the valuation, with a trailing P/E ratio around 28.82%, may appear high compared to its near-term earnings growth, as some analysts point out, the market is clearly pricing in that multi-billion-dollar future AI revenue, which is a departure from its historical valuation as a slow-growth stalwart. Looking ahead, the future outlook for Cisco stock is now overwhelmingly tied to execution on the AI infrastructure front. The opportunities are clear: converting that projected $4 billion in hyperscale orders into realized revenue and leveraging the recent Splunk acquisition to create a truly unified platform that can capture more of the cybersecurity and observability budget from enterprise customers. This integration, if successful, will be a major catalyst. The risks, however, involve intense competition from the likes of Arista Networks, particularly in the high-speed data center switching space, and the possibility of hyperscalers developing more proprietary in-house networking solutions, similar to what we've seen with other technology leaders like Tesla stock building its own Doja chip for AI, or Apple stock's move to in-house silicon. Another risk is if the global corporate IT spending environment tightens more than anticipated, slowing down that campus networking refresh cycle. The expectation was for Cisco to deliver another safe quarter, proving its resilience and providing predictable dividends, the classic conservative tech investment. The reality, however, is that Cisco has re-emerged as an unexpected growth story within the AI infrastructure boom, proving that even a market veteran can still deliver an outsized surprise. The tension between the old, stable narrative and the new, AI-driven one is what makes this stock worth watching closely. The stock surge to a 52-week high is a vote of confidence that this old dog has learned a very lucrative new trick. The focus shifts now from if they can compete in AI to how quickly they can scale those multi-billion-dollar orders. It's a testament to how quickly a shift in product demand, particularly in AI, can re-rate a stock's potential. This is a powerful dynamic that Fidelity brokerage clients, Robinhood investments traders, and users of the Interactive Brokers trading platform need to understand. The narrative has changed, and the valuation multiple is reflecting the future, not the past. Before we conclude, I'm genuinely curious about your perspective on this sudden surge. Comment below and tell us which stock you believe has the strongest hidden AI exposure that the market hasn't fully grasped yet, aside from the obvious names like NVIDIA stock and CSCO. Your input helps everyone see different angles. In summary, the core insight is that Cisco's current stock price action, marked by today's sharp rise, is driven by the market's realization that the company is a primary beneficiary of the AI data center buildout, transitioning from a cyclical networking story to an AI acceleration story. The expectation of stable, modest growth has been shattered by the reality of robust guidance anchored by multi-billion-dollar AI orders. This immediate insight, contrasted with the general perception of the stock as a low-excitement, mature tech holding, is why the stock is moving with such conviction. The tension between the old stable narrative and the new AI-driven one is what makes this stock worth watching closely. The stock surge to a 52-week high is a vote of confidence that this old dog has learned a very lucrative new trick. The focus shifts now from if they can compete in AI to how quickly they can scale those multi-billion-dollar orders. It's a testament to how quickly a shift in product demand, particularly in AI, can re-rate a stock's potential. This is a powerful dynamic that Fidelity brokerage clients